Hello students, welcome to Global Online. In today's lecture, we are going to see NTA UGC NET Paper 2 Commerce 2022 batch, and this is a lecture 4 on unit number 2, that is Accounting and Auditing unit. In today's lecture, we are going to see about the corporate accounting in depth. Before we start with the lecture, I want to tell you that we the Global Online providing the course for the paper 1 in which we are providing you the daily life lecture, notes on all the topic, last 10-year question papers with a detailed explanation, test series covering 2500 MCQ with the detailed explanation. To get this, download our app Global Online or WhatsApp on this number. Okay, and the fees for this is 3500 rupees only. Students, we are also providing course for the UGC NET Commerce Paper 2, for which you have to download our app, that is Global Online, from your Play Store. Once you download the app, you have to register your number and go in the store and search for the UGC NET Commerce Paper 2. In this course, you are getting the complete video lectures on all the unit, notes on all the unit, test series, plus the previous year question papers with a detailed explanation and target based preparation. And if you are taking this course, the paper 1 you will get the free of cost. No need to buy the paper 1 separately. Okay, and the cost of this course is 7,000 rupees only. The first and the most important topic here is share capital of the company. First, understand what is a share capital of the company. A company form of a business organization is a voluntary association of the person to carry on a business. Now, what is a business organization? It is a voluntary association of the person where so many persons are coming together and carrying out the business. It is an association of a person who generally contribute the money for some common purpose. Now here, to start a business, we require the money, right? For this, the person who are coming together, they contribute the money for the same purpose. The money so contributed is the capital of the company. The total share capital is divided into the number of a unit known as the shares. The money which they are going to contribute it to run a business, that money is called a capital. We are saying this money is a capital in the business. Okay, and this total share of a capital is then divided into the number of the unit. Supposing this is the total share capital, then this share capital will be divided into the numbers of the unit. Okay, and this small unit is called a shares. Equity shares capital. Here the equity shares are the main source of the finance of the firm. Now, to start a business, we require the finance, we require money. The people who decided to start a business will contribute their money, but that money are not enough to start a business. So, from where company will collect the money? And for this, the company will issue the shares. Okay, and here the shares, equity shares are the main source of the finance. It is issued to the general public. Okay, equity shareholder enjoy the right to control the affairs of the business, and all the shareholders collectively are the owners of the company. Here you might receive the question on this sentence that equity shares are the owners of the company. Okay, they do not enjoy any preferential right with regard to the repayment of the capital and the dividend. Nominal or authorized capital. It refers to that amount which is stated in the Memorandum of the Association as a share capital of the company. So here the authorized capital is the amount which we have already stated in the Memorandum of the Association as a shares capital of the company. The company will have a Memorandum of Association, and in that Memorandum of Association, company have already referred this amount, and this amount is called the authorized capital. The company is registered with this amount of the capital. This is a maximum limit of the capital which a company is authorized to issue without amending its Memorandum of the Association. So whatever amount we are recording in the Memorandum of Association, that is a maximum limit for the company to authorize to the issue without amending its Memorandum of the Association. Issued capital. It refers to the part of authorized capital of the company which has actually been offered to the public for the subscription in cash and the shares allocated to the vendor promoters for the consideration other than the cash. Okay. Issued capital is referred to the part of the authorized capital of the company. Now the authorized capital is the amount which we register in the Memorandum of the Association. Okay. And this capital is offered to the public for what? For the subscription. It will be in a cash and the shares will be allocated to the vendors and the promoters for the consideration other than the cash. It is a set the limit of the capital available for the subscription. Securities premium. The shares of many successful companies which offer the attractive rate of a dividend on their existing capital fetch a higher price than their face value in the market. There are so many companies which are working or which are there in the market, right? And this company offer the attractive rate of a dividend. Here the dividend means the interest which we are getting after we buy the shares. Okay. So here what the company is doing, they are charging the higher price for their shares above the face value. Now the face value means the original value of that particular share which is there in the market. When the shares are issued at the price higher than the face value, they are said to be issued at the premium. Okay. Now here, whenever the company is issuing the shares at a higher price than the face value, than the original value, that time we are saying it is issued at the premium, and thus the excess of issue price over the face value is the amount of the premium. For example, if a share of rupees 10 is the original value or the face value, is issued at rupees 12, then the 12 minus 10, here the rupees 2 will be the premium amount. Okay. Here the value of the shares is 10. We are issuing at a 12. That means the extra amount, the excess amount which we are charging will be the premium. Means rupees 2 will be the premium here. This is the security of the securities premium. Then is forfeiture of shares. If the shareholder fail to pay the allotment money or the call made on him, his shares are liable to the forfeited. Okay. If the company shareholder who are there, if that shareholders is failed to pay the allotted money, then his shares are liable to the forfeited. The forfeiture of the shares may be said to be a compulsory termination of the membership by way of the penalty for a non-payment of the allotment and or any call money. Okay. The effect of the forfeiture of the share is that defaulting shareholder lost all his right in the shares and ceased to be a member. The name of a shareholder is removed from the register of the members and the amount already paid by him is the forfeited. Here the forfeiture is the cancellation. It is a compulsory termination of the membership by way of the penalty. Here the company will charge a penalty for the non-payment of the allotment and the call money. And this creates the effect on the shareholder that all his right will be taken from him and his name will be removed from the register of the member and the amount already paid by him will be the forfeited. Then is the preference shares. Preference shares are commonly known as preferred stock, are those shares that enable the shareholder to receive the dividend announced by the company before receiving to the equity shareholder. Means before equity shareholder, they cannot receive the dividend, they cannot receive the interest on their shares. Then is debentures. Now what is debentures? The debentures is again the marketable security which is issued by the business or the organization. The debenture are an important source for a long-term borrowing of the company. It is again the source of the finance, the long-term source of the finance, from where the company can collect the finance. The procedure for issuing the debenture by the company is very much similar to that of issue of the shares. The procedures is similar to the issue of the shares. The how we are issuing the shares, in the same way we will issue the debenture, but it is for the longer period. Another important topic here is amalgamation. In an amalgamation, two or more companies are combined into the one by a merger or by a one taking over the other. Here, the two or more companies are coming together and they are deciding to combine into the one, maybe by the merger or by one taking over the other. And therefore, the term amalgamation contemplates the two kind of activity. The first activity is two or more companies join to form the new company, and the second one is the absorption and the blending of a one by the other. Thus, the amalgamation include the absorption. With regard to the amalgamation, the Accounting Standard 14, the Institute of Chartered Accountants of India has introduced the Accounting Standard 14, that is AS14, which is accounting for amalgamation. And this question you receive in the match the following, where they are giving you the accounting standards and they will be asking you the name of that accounting standard. So please remember this, the accounting standard 14 is with regard to the accounting for the amalgamation. Then is vendor and vendee companies. A company going to liquidation or a merge the companies are called a vendor company or a transferor company. The company who want to get a liquidated, who want to get a end up or a merge with the other companies, that time we are saying the vendor companies or the transferor companies. The new company which is a form to take over the liquidated company or the company with which the transferor company is a merge is called a transferee or the vendee. Okay. In case of amalgamation, the assets and the liability of the transferor companies are amalgamated and the transferee company become the vested with all such assets and liabilities. Here in case of the amalgamation, where the assets and the liability of the transferor company is getting the amalgamated and the transferee company is becoming the vested with all the assets and liability, that you have to remember here. Liquidation of the companies. The liquidation is the legal procedure by which a company comes to the end. Thus, the company, being a creation of a law, cannot die in a nature. The company, when found necessary, can be liquidated. Liquidation is the winding up when the company is doing a legal procedure to end up the organization. The winding up of the company or a liquidation of the company is the process by which a company assets are collected and sold in order to pay all the debt, where the people who are working in the company, the owner of the company, will decide to sold off all the assets and pay all the debt whichever are there. So students, we have already completed the basic principle of the accounting, in which we have seen the concept, the conventions, Then is a partnership firm, where how the partner is getting admitted, the retirement, the death of the partner, reconstruction of the partnership. And in today's lecture, we have seen the corporate accounting, the issue of the shares, the reissue of the shares, forfeiture of the shares, the preference shares, amalgamation, liquidation of the company. For tomorrow's lecture, we are going to see the holding of the company, so don't miss tomorrow's lecture. Till then, keep watching, keep learning.